We are about to discuss diversification. This explains that if you don't put all your money into one investment, you can flatten the swings in your portfolio. You will then be more likely to protect yourself when markets fall and also optimize your portfolio returns. It's peak traffic time and Harry is getting late for an important client meeting. He hits the freeway and directly gets into the fast lane. He soon realizes that the next lane is actually moving faster at 60 miles per hour and decides to change lanes. All of a sudden, Harry's lane hits some traffic and it has slowed down to 45. He moves back into the fast lane, which is moving at 55 miles per hour. Bad move again, really bad traffic ahead, and the movement has slowed down to 40 miles per hour. Some people invest like they drive. They buy a fast lane, studying its past performance, but lose money in the process. Investing doesn't have to be about choosing one lane. You can have an investment in more than one lane. This is called diversification. Consider the various asset classes. Historically, they haven't always moved in the same direction at the same time. The degree to which these asset classes move in the same direction is called correlation. Two asset classes can be positively correlated when both go up, just as when the cost of real estate goes up and the stock price of a construction company also goes up. Similarly, two asset classes can be negatively correlated when one goes up and the other goes down. For example, when the price of oil goes up, the stocks of an oil company come crashing down. You want your asset classes in your portfolio to be non-correlated. Let's look at an example. Harry owns Indian stocks in mid-cap and large companies and Indian real estate stocks. Now, Indian companies get a substantial portion of their revenues from overseas. During the US subprime crisis, the US stocks came crashing down. Since the US economy is highly correlated to India's economy, the fall in US market directly affected the Indian commercial and industrial real estate market. This in turn caused Indian real estate stocks to go lower. What if Harry added another lane to his freeway portfolio? Enter government bonds and corporate debt. When Indian stocks crashed, Indian companies were quick to make up for the dip in foreign investment by issuing corporate bonds with hugely attractive returns. So if Harry had added Indian government and corporate bonds to his portfolio of Indian stocks and Indian real estate stocks, he would be more diversified. Some of these lanes are inherently risky if you just choose that one lane. However, when you put the lane as a component of your overall freeway portfolio, it may reduce the overall risk of your portfolio and thus save you from a nervous breakdown. Yay! Here is how the different asset classes typically perform. While cash and fixed income give steady returns, real estate, commodities and equity change the landscape with very high polarities. See what happens when you reduce the risk of your portfolio? So build a freeway of non-correlated lanes. There could be potential risk in rearview mirror investing. Diversify your portfolio so you won't have to feel like you have to pick the best lane.